Good day, students. And today we are going to study about decision techniques in capital budgeting, and specifically, we will deal about net present value. To start with, uh, what are the learning outcomes for this particular topic? First of all, we want at the end of the lesson, students can be able to analyze and comprehend the definition of net present value. Why is net present value important to the business? Is net present value used only for multi corporations or international corporations, or net present value is also applicable for micro, small, and medium enterprises? We will be able to answer that at the end of our lesson. And why is it necessary to compute the net present value? So those are our learning outcomes. To start with, our topic deals with net present value. Net present value is one of the management tool, no, or accounting tools that deals with capital budgeting. And we are precisely concentrated on net present value. Present value. Net present value, as you can see, is one of uh, decision tool used in capital budgeting. But before anything else, let us discuss what is capital budgeting. Capital budgeting is a process of you need to evaluate, you need to appraise whether a certain capital expenditure or investment will be profitable. No? What are examples of capital budgeting? Examples of capital budgeting are uh, examples of capital budgeting are purchase of new equipment, or a purchase or construction of a building facility, or a purchase of machinery, or a purchase of real estate property like land. So you need not a small amount but a huge amount, a large amount of capital, no, to be invested in that particular project. Another example is rebuilding existing equipment or rehabilitation of existing equipment, especially if that equipment is entails a lot or a huge amount. If you want to buy a new equipment or better rehabilitate, and then you need to procure delivery vehicles. For example, you are in distribution management, you are a wholesaler or a retailer, you need to deliver goods to your retailer if you are a wholesaler, or you need to deliver goods to your customers, so you need to purchase a fleet of delivery vehicles, or constructing additional buildings, like for example expansion. So those are examples of capital budgeting. And this capital budgeting is involves really a large amount of expenses or investments. It is not sometimes entrepreneurs would go to the banks, no, to seek loans, whether the loans will be paid long term or short term. Okay, so this is capital budgeting, and if you have a potential project, you need one of the tools to analyze whether you have to proceed with the project, or will the project be profitable, or it will produce a positive sign, meaning to say the cash inflow is more than your cash outflow. Okay? So this is capital budgeting. And again, you need to decide, no? whether if you are going to invest your money in that particular project, you need to have a decision. And one way of uh, helping you to decide, no, objectively, is to use net present value. In financial management, in financial management, remember these students, in financial management, it is about budgeting, forecasting, and planning. So here, you need to have a forecast, no? A forecast of, if for example, we have a proposed project and our time or the duration of our project, we will have to forecast it on a yearly basis. Example, how much is the profitability every year for 5 years, no? So this is forecasting. Okay, so in capital budgeting, okay, you deal about gathering of data, no? Of course, you need to gather data, how much, what will be your variables when it comes to operational expenses, and what is the current value of that particular machinery, property, or land, no? So you can have a better idea that when you budget and forecast, more or less you have a marginal error. And one of the process again is gathering information and make cash flow estimate, no? Estimate, no? Forecast and budgeting, estimation. And then you make a decision now, and then you evaluate and review. Okay? So this is the a simple process of capital budgeting, where you need to gather ideas, gather concrete informations, and make some computations, forecasting, and estimates of how much will be your fixed expenses and variable expenses. Of course, the totality is your OPEX that will, somehow forecast it for a strategic or long-term period. Okay. Again, before we move to the next slide, if you are new to the channel, please subscribe and like and share. Thank you very much. And now, let us proceed with the next slide. Why are cash flows discounted? Why do we need to discount cash flows? Cash flows has two types, no? For example, this is the company. Okay, okay. If you have an investment, an expenditure, that is called cash outflow. Outflow meaning to say it's going out. And if you have income, revenues, it is called cash inflows. Okay? So, here, in a particular, if you want to compute the net present value, the cash inflow on the first year is discounted so that you will know the discounted cash flow. Now, the question here is why? Why do we need to discount our cash flow? There are two reasons. Number one is to adjust for the risk of our investment and opportunity. No? Of course, the higher the risk, the higher is the reward, and vice versa. And also to account for the time value of money. No? There are present value of money and future value of money. Okay? Let's go to the risk of assessment, risk of an investment, or an opportunity. Okay? Number one reason why we need to discount cash flow is to adjust the risk or the stake. Necessary because not all businesses and projects or investment opportunities have the same level of risk. I told you, the higher the risk, the higher is the reward. No, major. If you have a large investment, it is, and on this particular project or business, of course, it takes a risk. So that's why cash flow has to be discounted to consider the risk of the investment. Okay. Number two is the time value of money. Ah, time value of money. Okay. All right. For the time value of money, we consider that, for example, you save 1,000 pesos today. How much will it be if the interest is 10% after 2 years? No, and that is the time value of your money in the future after 2 years. No, so 1,000, that will be 1,100. No, you earn interest of 100 pesos. Okay, that is time value. So these are the two primarily good reasons why you need to discount cash flow, to consider the risk of the investment and to consider the time value of the money. Okay. Now, why is net present value analysis used? Okay. Net present value analysis is used to help identify uh, how much an investment or an expense or a project or any series of cash flows is worth. Remember, we have already defined our two cash flow. We have the inflow cash flow and we have the cash outflow. Cash outflow is going out of the company while cash inflow is going inside the company. Remember that. Okay. Now, net present value analysis is used also to, to consider all the variables such as the revenues, the expenses, the capital costs associated with the investment in its free cash flow or FCF, free cash flow. And the last is you have to factor in all the revenues and costs. It also takes into account. Remember guys, the formula for profit. Profit is equal to revenues or sales minus expenses. And the difference in that is profit. If it is positive, you have gain. If it is negative, you have loss. No? If there is no positive, there is no negative, it is called break-even cost. Okay? So, that is why the net present value analysis is used because you consider the risk of the investment, you consider the value, time value of money, you consider also the different variables such as revenue and expenses. So that's why the net present value is being used to analyze whether a certain project or investment is profitable or not, considering all the risk of exposure. Okay? And then, uh, by the way, after we are just studying one decision technique, which is net present value. Next module, we are going to study the payback period, and after the payback period is the internal rate of return or the acronym IRR. Okay? So, therefore, we are, at this particular module, we are more focused on the net present value. And next module, we will discuss about payback period. Okay? Alright. So, net present value, it is the difference between the present value of the cash inflow, okay, and the present value of cash outflow over a period of time. We know for a fact that it is used in capital budgeting as one tool, no? Because there are other tools like IRR and payback period. If you will make all of these decision tools or techniques, well, much better, you are pretty sure that your investment was evaluated thoroughly. Okay? So, the formula for net present value is the summation of the cash flow over the quantity 1 plus the discounted rate raised to the number of period. Okay, this one. Okay, so this is the formula. Okay, and CF stands for future cash flow during a single period. Okay, let's say 1 year cash flow is 30,000. Second year cash flow is 20,000 again. Okay, so that is the cash flow. And the I or R, okay, signifies the discount rate or return that could be earned in alternative investment. And of course, the T is, or the N is the number of periods. So that is again the formula of the net present value. This is simple. I am going to explain to you in layman's terms the computation of how to analyze and solve net present value problems. Okay? But for the meantime, we know for a fact what is the importance of net present value, why is net present value analyzed, and why are cash flow discounted. Because we are considering the risk of investment and the expenses and the time value of the money. Okay? And net present value is a process to evaluate, no, whether a certain project or a business is profitable considering all the risks. Okay? So, here's the decision making for net present value. If the net present value is positive after computing, no, then proceed with the project or accept the project. This indicates that the earning from the project or the profit from the project is more than the amount that you invested in that certain project. So, your decision is to accept the project if the net present value is positive. However, in contrary, if it is negative, if the net present value is negative, do not accept the project, meaning to say a negative sign indicates that the project in which we invested the money does not provide a positive return. Okay? So the project should be rejected. So that is the decision making when you are computing the net present value. So before you can decide, students, you have to compute first the net present value so that you can identify what is the sign, whether is it positive or negative, and then you are going to recommend your decision. So let's start here. I have a realistic example here. So the word problem is this. A beauty parlor owner requested you to help them decide for a purchase of an equipment costing 100,000 pesos. So, meaning to say the cost of the equipment for that beauty parlor will be 100,000. So that is cash outflow because that is an investment. Okay? Cost of initial investment. The discounted rate of return is 10% for a duration of 5 years. Okay? The forecasted income for the first year and second year is 30,000. So the forecasted income, what comes into the company, we are referring to the cash inflow. For the first year, it is 30,000. First and second year. Third year, it is 40K. Fourth and fifth is the same, 50K. So this is your income, no? For the duration of 5 years. Breakdown to every year or annually. So, what you are obliged to compute the net present value and recommend your decision to the Filipino entrepreneur who is a beauty parlor. Maybe you are taking up financial management or business finance, and probably one of your relatives who wants to invest in a certain project or business would like to seek your help. What is the decision to accept or reject the project? So, net present value can be of great help. All right. So, let's write all the given. So, the investment is 100,000. So, that is your cash outflow. And the rate of return or discounted rate is 10% for a duration of 5 years. On the first year, your cash inflow is 30,000. 30,000 on the second, third is 40,000, and on the fourth year it's 50,000, and fifth year again equal. So you are required to compute the net present value so that you will identify whether it's a positive sign or a negative sign, and what is your recommendation or decision. So first, you have to compute, no, the your discounted cash flow for the first year. Okay? So the formula for net present value is the cash inflow or cash flow for that particular year over 1 plus the interest rate of 10%. So in order to get 0.1, you have to divide 10% by 100. It gives you 0.1%. Okay? Alright, so that's why it is like this. So, if you will not divide this by 100, because that is in percent, your answer is already wrong. So, be careful, ladies and gentlemen. Be sure that that 10% given should be divided by 100 in order for that to be decimal point. So, we just transpose that to the formula. We compute the discounted cash flow for the first year. So, this one, let us erase this one. Okay, let's continue. So, 30,000, we are computing for the first year. So, this is the first year. So, 30,000, bring down, okay, over, that one is constant. And you divided 10% by 100, so it gives you 0.1. Okay? Alright. So, close in parentheses, 1 plus 0.1 raised to the, this one should be raised to the first power. No? That is a, so this is 1. So, 1 plus 0.1 is 1.1. So, 30,000 divided by 1.1, okay, gives you a discounted cash flow on the first year, 27,272, and then you run for 4 decimal places. Okay, now, the next step is to compute. We are talking of the long method because there is a long and there is a short method for computing the net present value. But for this time, I'm talking about the long method of computation. Okay. Alright, so what you need to do to compute for the second year, you bring down 30,000. Okay, the R is 0.1. Okay, so for the second year, the cash flow is 30,000 over 1 plus 0.1 raised to the second. This one is to the second. Okay, all right, and then you multiply 1.1 2 times, or uh, that is 1.21 times equal gives you 1.1 times equal gives you 1.21, no? 1.1. Okay, so 1.1 raised to the second power. Okay, okay, so it gives you 1.1 times 1.1 because second year, no? So it gives you the answer of 1.21. So 30,000 divided 1.21 gives you 24,803.3884. And then for the third year, just third year, 40,000 over 1.1. Where did you get 1.1? 1 plus 0.1 is 1.1. So 1.1, because it is on the third year, raised on the third, gives you 1.331. And if you divide, you have an answer of like this for the third year discounted cash flow. Now, on the fourth year, you will have 50,000. Where did you get 50,000? Because this is given, no? 40,000, and then divided 1.1 raised to the fourth power, it gives you 1.4641, and then 50k divided by that, it gives you 34.15. Same is true if you will follow the process. 1.1 raised to the fifth power, the value is this one. You divide 50,000 by this and you have an answer of like this. Now, this is not yet finished. That's why it's called Lang method. So you have to add all of your discounted cash flow for every year. So first year, let's erase this one. So first year, okay, this one, yun, yun. Second year, this one. Third year, this one. Fourth year, this one. Fifth year, this one. Okay? So you add them. That's why there is a summation in the formula. So the total answer is 147 325,447, meaning to say that is the discounted cash flow, the total or aggregate discounted cash flow. But the formula for net present value is the discounted cash flow minus the cost of investment. The cost of investment is 100,000. Therefore, 147,325 minus 100, which is the cost of the investment, that is the formula. So you have a positive 47,325. So that is your final net present value. If you invest 100,000 for that kind of business, okay, it will give you a net present value of 47,325. Since it is positive, the decision, it indicates that the profit of the project is more than the amount, no? More than the amount that you invested in, so the project should be accepted. You see, it's more than, no, the amount of your investment. 147 is greater than 100,000. So that is the long method for the net present value. It is very easy because, I designed the methodology of teaching step by step. So you cannot be mistaken in your assessment. Okay. The next is the short method. In the short method, you will have just to tabulate all the givens. This one is the start or the zero. Okay. So first year, you have 30,000. Second year, you have 30,000. Third year, you have 40,000. Fourth year, you have 50,000. And the fifth year, you have 50,000. So you have to tabulate. The first column is the year, 0 or start. First year, second year, third year, fourth year, fifth year, because the duration of the project is 5 years. So, on the second column is your 10% discount factor that is given. This one is your cash inflow. But the zero, this is negative because it is going out. That is your investment. That is why it is a negative sign. These ones are positive because it is going in. Positive. Okay? Alright. Okay. So the third column is your cash flow, and the last column is the discounted cash flow. Okay. Now, the question here, guys, is this one, these rows can be computed after we determine the different discount factor. How are we going to find this one? That's why it's called a short method, because there is a particular factor that you have to input. And this factor is already found in this present value interest factor table. You can see here, guys, that it is 10%, so you are particular with this column. 10%. If the given is the discounted rate of return, let's say, is 5%, so you are particular to look on this table, the 5%. Okay. Now, if on that particular you already identified that this is the column, you are going to find the number of years on this light sky blue color. Since the problem is 5 years, we will just pick the intersection of each. Let's say, the first year, you must use this factor. And then on the second year, you must use this factor. On the third year, you must use this factor. And then on the fourth year, you must use this factor. Now, if for example, on the first year, okay, your cash inflow is 30,000, okay, so 30,000 times, just copy this one, 0.9091. So the product that you are going to get is the discounted cash flow for the first year. No? Okay. Now, if you want to compute, okay, if you want to compute your discounted cash flow for the second year, okay, what factor are you going to use? I think this is 30,000 also. What factor are you going to use? Huh? Check 10% because that is the discounted rate, and you are a second year. There you go. Correct. It's 0.8264. Very good. So for the third year, if the third year the cash inflow is 40,000, you multiply 40,000 by 0.7513. So the product is your discounted cash flow for the third year. And then for the fourth year, it is 50,000 cash inflow. Multiply that by 0.6830. Okay, you try the fifth year. The cash inflow is 50,000. You multiply that by one factor. Very good. 0.6209. So the product of that is the discounted cash flow for the fifth year. And then you add all of that summation, you add all of your answers for the discounted cash flow, and then minus it by the capital investment. So you will find out the answer here. The difference, whether that is positive or negative. Again, accept the project if it is positive, reject the project if it is negative. So, that ends my lesson for decision technique in capital budgeting, and we studied about NPV, which is net present value. Again, I will encourage you so that you can receive my tutorial videos every time I upload it. Please subscribe and like and share the channel. Thank you very much. See you later. Keep safe.